Welcome back to Iron Financial. This is the place where we help you forge a stronger portfolio by stress testing the market's biggest stories. Now today, we are putting JBL's latest Q2 earnings report directly into the furnace. And on the surface, the numbers look absolutely incredible. I mean, we're talking about a blowout quarter by pretty much any measure you can think of. But our job here, as you know, is to go deeper. It's to hammer on the fundamentals, to separate that high-grade steel from the brittle cheap iron. We're going to see what holds up under pressure. So let's get right to work.
Whoa, hold on a minute there. Everyone is celebrating this massive headline beat, and that's great. But are we really sure we're not just looking at a beautifully polished veneer? You know how this goes. The stock pops, the celebratory press releases start flying around, but a real builder always checks the foundation first. And that is exactly what I want to do today. Is this company built on solid steel, something that's going to last, or are there some serious cracks that everyone's just painting over? I think that's the real, crucial question we've got to answer.
You know, you're absolutely right to ask that, and that's precisely why we always start here, with the setup. Before we can even begin to understand the sheer force of this earnings report, we have to understand the environment it landed in. We have to look at the raw material, the billet, if you will, before the hammer of the results came crashing down. We need to know, what was Wall Street expecting? What had they already priced in? Because without that context, the numbers don't mean a thing.
And let's be crystal clear about something. This was not a low bar, not by a long shot. The market wasn't sleeping on Jabil. The expectations were already red hot, already baking in some pretty significant, powerful growth. This wasn't some turnaround story where everyone was just hoping for a little good news. No, this was a high-growth narrative that demanded strong performance just to keep pace. The pressure was on from the absolute get-go.
Okay, let's really dig into these numbers from the Zacks consensus estimate because this tells the story. The street wanted to see $7.75 billion in revenue. Now that alone would represent a more than 15% jump from the same quarter last year. That's a really solid increase. But the earnings story, that was even more aggressive. The consensus was looking for $2.50 per share in core EPS. And remember, core earnings are what really matter to us because they strip out all the one-time weirdness, all the non-recurring items. It gives you a much cleaner, more honest look at the company's real profitability. And at $2.50 a share, the market was pricing in nearly 29% year-over-year growth on that pure core bottom line. That's a massive, massive expectation to meet.
Right, exactly. So you've got these massive expectations, but it wasn't a blank check. The market might have been bullish on the growth, but if you were paying attention, there were some definite undercurrents of caution. It wasn't some universal strong buy across the board. You could feel this sense that maybe, just maybe, things were getting a little bit stretched, that the easy money in this stock had already been made. And look, this is a crucial point for anyone who's looking to build a real position. You've got to see the whole picture, not just the rosy headlines.
And this right here is where that conflict really comes into focus. Before these earnings came out, Jabil was sitting at a Zacks rank of number 3, which is a hold. Now, look, a hold is not a sell signal, don't get me wrong, but it's sure as heck not a roaring vote of confidence either. It's basically Wall Street's way of saying, yeah, we see the potential, but we also see the risks. We expect this stock to perform with the market, not necessarily to crush it. So you've got this incredible tension baked in. Huge aggressive growth targets on one side, and this neutral, kind of cautious rating on the other. That was the setup.
And then, the hammer fell. This is where the story really gets intense. Jabil steps up to the plate to report. The whole street is holding its breath. And they didn't just meet that incredibly high bar, they took a sledgehammer to it. The numbers that came out weren't just good. They were a statement of force that made absolutely everyone sit up and pay attention.
Obliterated. I mean, that's really the only word for it. This was not some little incremental beat. This wasn't a rounding error. This was a fundamental, powerful outperformance that forced every single analyst on Wall Street to go back and completely rework their models. It was a clear message to the market that the internal momentum at this company was far, far stronger than even the most optimistic bulls had dared to price in. Okay, let's look at the raw power of these numbers.
So let's start at the top line. The consensus, remember, was $7.75 billion. Jabil delivered $8.3 billion. Let that sink in. That's a beat of over $500 million. Think about the scale of that. They didn't just squeak by the target, they blew past it in a different zip code. A beat of this magnitude, that isn't just a sign of good execution. It is a sign of overwhelming demand and total market dominance in their key areas. It's just pure, unadulterated strength.
And that strength, that power, it flowed directly down to the bottom line. The street wanted $2.51 in core earnings per share. Jabil delivered $2.69. That's an 18-cent beat. They proved, without a shadow of a doubt, that this massive revenue growth wasn't coming at the expense of their profitability. They were scaling up, and they were scaling up efficiently. This is that classic 1-2 punch that every investor dreams of seeing. A massive revenue beat, followed immediately by a powerful earnings beat. It's the unmistakable sign of a well-oiled machine that is just firing on all cylinders.
Okay. The beats are impressive. I'll give you that, no question. But I want to focus on this number for a second. A 23.1% revenue surge year over year. That's accelerating growth. The expectation was for 15%, and they delivered over 23%. So the question for me isn't if they're strong, it's where is that strength actually coming from? Is this some broad-based boom that's lifting the entire company? Or is one part of the business doing all the heavy lifting while other parts are starting to rust? We have to look inside the engine room.
An excellent point. And you know what? It's the most critical one for any real investor. Headline numbers are for amateurs. A professional analyst, someone who's trying to build a portfolio that will last, goes deeper. You have to pop the hood and inspect the engine itself. Where is the real torque coming from? A company's true, durable strength isn't in the total number. It's in the health of its core operating segments. So, let's do it. Let's break these segments down and see what's really driving this thing.
All right, so this is what the map looked like before the report dropped. This is what analysts were expecting. They saw the business being split roughly like this. You had regulated industries coming in at about $2.8 billion. You had connected living and digital commerce at about $1.2 billion. And then the big one, the real heavy lifter, intelligent infrastructure, at nearly $3.8 billion. So clearly, this segment was expected to be the biggest piece of the pie. But the real story, the one that tells you everything you need to know, is in the growth rates.
And here it is. This is the whole story in one chart. It's truly a tale of two different segments. On one side, you have an absolute monster, intelligent infrastructure. Analysts were forecasting a mind-blowing 42.1% year-over-year growth. This is the engine. This is where all that explosive power is coming from. But then, on the other side, look at connected living and digital commerce. It was expected to shrink by nearly 10%. That is a significant and, frankly, pretty concerning divergence in performance.
And hey, don't just take my word for it. The CEO, Mike DeStore, he confirmed it himself. He points directly to the source of that 42% growth: cloud, data centers, networking, communications. I mean, these are the absolute pillars of the modern global economy, and Jabil is sitting right in the middle of building them. And listen to his language. It's not cautious, it's incredibly confident. Demand remains robust. That tells you this isn't some one-time search. They see a durable, long-term trend that is powering this segment forward. This is the steel beam that's supporting the entire structure. But that's the risk, isn't it? That's the part that keeps me up at night. We've got one engine running white-hot, pulling this entire train forward at incredible speed. But another car is actively dragging it backward, shrinking by nearly 10%. So for how long can one segment's incredible growth mask a decline in another? And it forces you to ask the deeper question, why is that other segment shrinking? Is it a problem with their specific products, or is the entire market for connected living just cooling off? That feels like a potential crack in the foundation. And any structure that's relying on a single beam, well, that beam had better be absolutely unbreakable.
Which brings us right here to the tempering process. See, you can forge the most beautiful, impressive-looking blade, but if you don't temper it correctly, if you don't expose it to stress to strengthen it, it can shatter under the slightest bit of pressure. A true analysis requires us to do the exact same thing to these earnings. We've seen the good news. Now let's apply some real pressure and see if the company's armor holds up or if we can find those hidden cracks you're worried about.
And this is the very first thing that gives me serious pause. MarketBeat is reporting that in just the last 3 months, company insiders have sold a really significant amount of stock. And we're not talking about some small scheduled sale for tax purposes. We're talking about nearly $38 million worth of shares. Now look, insiders sell for all kinds of reasons. But when you see a wave of selling like this, especially after a huge run-up in the stock price, you have to ask the hard question. If the future is so unbelievably bright, why are the people with the most information cashing out their chips?
Let's break it down, because the specific details really matter here. Over 161,000 shares sold in just 3 months. The CEO himself sold 15,000 of those shares. And okay, insiders as a group, they still own about 1.35% of the company. But this volume of selling is a bright yellow flag. It is not a definitive signal to sell your position tomorrow morning, but it is a piece of hard data that directly contradicts the overwhelmingly bullish story we're hearing from the earnings call. And when the people on the inside are acting differently than the story they're telling the public, that's a friction point you have to investigate.
And here is the other major stress point, valuation. The bull case is simple. It's powerful. Profits are soaring, revenue growth is accelerating. But the skeptic's question is just as important. Are you paying way too much for that growth? The stock is trading at a price-to-earnings ratio of 40.8. That is a rich valuation. I don't care who you are. By any historical standard, that's high. It means the market isn't just pricing in this quarter's great results, it's pricing in absolute perfection for many, many quarters to come. And any stumble, any slowdown, and a stock with a P this high can get punished and punished severely.
Okay, those are valid concerns. They really are. Insider selling, a high valuation, these are critical stress tests, and you have to look at them. But the absolute best way to counter that skepticism is to look at the company's own blueprint for the future. Let's forget what analysts think for a second. Let's forget what the PE ratio is today. Let's look at the guidance that management, the people who are actually running the company day to day with their hands on the controls, have laid out for us. This is their own forecast, their own commitment. This is what they see coming.
And this right here is where the bull case regains its footing and pushes back hard. Just look at this table. They didn't just nudge their guidance up a little bit, they took it up substantially. They raised their full-year revenue forecast from $32.4 billion to $34 billion. That's a $1.6 billion increase to their outlook. And they boosted their core EPS outlook from $11.55 all the way to $12.25. The crucial point here is that management is so confident in the business trends they're seeing right now that they have put a stake in the ground, promising even better results for the rest of the year than they thought was possible just one quarter ago. This is a direct counterargument to any narrative of a potential slowdown.
And it goes way beyond just revenue and EPS. Management is committing to a core operating margin of 5.7%, which speaks to sustained, high-quality profitability. They're forecasting over $1.3 billion in adjusted free cash flow. That is the lifeblood, the oxygen of any healthy company. And this right here is the direct answer to your insider selling point. The company itself has already repurchased $600 million of its own stock just this year. So while a few individuals are selling some shares, the corporation with its billions in cash is a massive, massive buyer. That is a powerful vote of confidence in their own stock price.
All right, we've heated the billet, we've hammered on the results, and we have stress-tested the final product. We have seen the overwhelming, undeniable strength, and we have identified the potential cracks in the armor. So it all comes down to this single question. What is the verdict? Is Jabil a solid opportunity that you can build on, or is it a trap waiting for unwary investors who are just chasing the latest hot performance? It is time to forge a final analysis.
Just look at this scorecard. On the left side, the structural strengths, the massive beat on revenue and EPS, the explosive growth in their most important segment, the raised full-year guidance, the powerful free cash flow. This is the steel core of the company. It's undeniable. But you cannot just ignore the other side of this ledger. The significant insider selling is a fact. The shrinking connected living segment is a fact. And a sky-high valuation of over 40 times earnings is a very real risk. Those are serious potential fractures. The market is telling us two things at once. There's incredible strength here, but it comes with significant risk and a very high price tag. You have to weigh both sides.
So here it is. Here is our verdict from Iron Financial. Jabil's operational core is solid. It is forged from high-grade steel, and it's being powered by the massive secular trends in cloud and AI infrastructure. This company is executing at an extremely high level. However, you are paying a premium for that quality. The current valuation leaves very little room for error, and that pattern of insider selling is a warning sign that requires constant monitoring. This is not a buy-and-forget stock. It's a buy-and-be-vigilant stock. The foundation is strong, but you absolutely need to keep a close eye on those warning lights on the dashboard.
And that is the final question that we leave with you. We've laid out the blueprint for you. We've shown you the structural steel, and we've pointed out the potential stress fractures. Right now, the company has proven it can handle the weight, but is this a structure you feel confident building your portfolio on for the long term? Or do you believe that the cracks we've identified, the high price, the insider selling, that shrinking segment, will eventually widen under economic pressure and cause a failure? The decision, as always, is yours to forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.